when you throw into the mix that VanEck fund says if the dollar really did lose reserve status, we could see, and this is their emerging market bond team, so we could see gold go to 139,000 an ounce. That's them saying this. And people say, well, is gold going to be revalued? We've talked about how James Rickards says 24,000 and how Luke Groman, I think, is a smart, if I had one phone a friend guy on anything, it might be Luke Groman, smartest dude in the world, Tether being the one that will do primary issuing, but you'll get all the banks and the insurance companies, and they'll all issue stable coins, but they all have the same rules. They got to be backed by these treasuries. And if you get them to buy gold with the accumulated interest as part of a deal, whatever that deal is, well, you push gold to the moon. You don't have to revalue it synthetically.
The global financial landscape is rapidly approaching a seismic shift as the US dollar's dominance faces mounting international pressure. Central banks and institutional funds are actively preparing for an unprecedented restructuring of the monetary order. Andy Schectman, a prominent precious metals analyst and CEO of Miles Franklin, projects that skyrocketing gold valuations will inevitably redefine global liquidity. He highlights forecasts from VanEck suggesting gold could catapult to $139,000 per ounce if the greenback forfeits its reserve status, alongside major calls targeting $24,000 per ounce, rather than relying on direct synthetic price fixing. Institutional demand driven by stablecoin issuers accumulating gold with Treasury yields could propel prices to extraordinary heights. This strategic surge in precious metals aims to quietly devalue the dollar, enabling the United States to reshore manufacturing, eliminate trade deficits, and manage its massive national debt. Now, we present the clips from Andy Schectman's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
When you throw into the mix that VanEck fund says if the dollar really did lose reserve status, we could see, and this is their emerging market bond team, so we could see gold go to 139,000 an ounce. That's them saying this. Well, and people say, well, is gold going to be revalued? We've talked about how James Rickards says 24,000 and how Luke Groman, I think, is a smart, if I had one phone a friend guy on anything, it might be Luke Groman, smartest dude in the world.
And you're my phone a friend, Andy.
Oh, thank you, Michelle. You're too kind, but
Luke Groman,
he's a different level. And I heard him say, maybe even on your show once, that he could see it organically going to a point and then either being marked to market or revalued. But using Tether and any of the stablecoin issuers, Tether being the one that will do primary issuing, but you'll get all the banks and the insurance companies, and they'll all issue stablecoins, but they all have the same rules. They got to be backed by these treasuries. And if you get them to buy gold with the accumulated interest as part of a deal, whatever that deal is, well, you push gold to the moon. You don't have to revalue it synthetically. You can let the market do it, even though it is being synthetically revalued, but yet organically. Synthetically in that treasuries are being purchased via the movement of money. That's synthetic, but taking that interest and buying gold with it is organic to a degree, synthetic also, but push gold to the moon. And by doing that, you're not doing it because you want gold buyers to get wealthy. You're doing it because you want to devalue the dollar to reshore manufacturing, to pay down the debt. In a strong dollar, you can never, ever, ever have a trade surplus. You can build all the manufacturing you want. You have to sell it. It's the same reason why the Chinese were able to win a contract on rebuilding the Oakland Bay Bridge, shipping all the materials from China because it was too expensive here. There, it's not. That's part of being the reserve status. Currencies just depreciate against yours. To buy dollars, to buy energy and commodities, you can't do it. I don't think the BRICS want to be the reserve currency. I don't think China wants to be. They just want to make it parallel so they're not reliant on the US dollar. And that in and of itself, because of the way the system is set up, will be very detrimental on the United States. It's not that anyone wants to be the reserve because they see what happens to your manufacturing capacity if you are. But how about alternative? And that's what this is all about. The ramifications simply from a viable alternative that is mature and is cooperative is the death knell to the US system. It doesn't have to replace it, and it's not going anywhere anytime soon, but just augmentation of the status quo is enough to in an over-leveraged, massively indebted system like this is enough to turn over the apple cart. Talk about the Genius Act and demand for the Treasury. It's synthetic demand to the nth degree. The backing of the Genius Act says that anytime money moves in U.S. dollars globally from January forward, it will be stablecoin, instant settlement on blockchain backed by stablecoin, primarily backed by 90-day or less short-term treasuries. Synthetic demand, which, by the way, neuters the dual mandate of the Fed. Right? Warsh already said he wants to get rid of the full employment mandate, but the stable pricing with interest rates, if money moves everywhere is backed by short-term treasuries, you're pinning the front end of the curve to the ground. Not like the overnight lending rate can be higher than the 90-day treasury, or nobody will lend, and the banks will just give it back to the treasury or to the Fed that will earn higher interest than they can on the front end of the curve. So with safety, so you're killing the dual mandate of the Fed, which some say that's Trump is out to do that. Number two, you're pasting the front end of the curve to the ground, which would stimulate business activity. And number three, yes, it gives people the ability to use it around the globe much quicker, but remember what we're seeing with companies like Tether. What is being done with the interest that is not transferable? Now, this is where I get into conspiracy theory, I guess you could say. It's my own feeling. They were in trouble, the Tether was, with the Justice Department. What happened to that? Why is that gone? And they own more gold than anyone, but the central banks bought more than anyone but Poland for the last few years. Why is that? Why is no one talking about that? And Bo Hines, the CEO of the Genius Act compliant division of Tether, well, he was Trump's crypto czar through last August. Now, the rules that he helped make, he's benefiting from. They're buying all of this gold. What if, just what if? We saw what they did with the Iranians. They said, hey, you guys, here's 4 wallets tied to, you guys being the Justice Department, tied to the IRGC. And Bessent got up on stage and said, the Iranians don't even know that their money's dead and gone. They haven't even figured it out yet because we disabled the stable coins at the smart contract level. So not only did Tether open up the back end to the Justice Department, we're partners now. You got Bo Hines in there, and they're buying all this gold. Why? We've talked about Triffin's dilemma, which says that you'll always have a trade imbalance if you're the reserve status. Richard Russell said, inflate or die, or produce more than you consume. Well, we consume more than we produce. How do we reindustrialize if Triffin's dilemma says we can't? How about we soft default on the dollar, a la Jared Bernstein, a la Vice President Vance? Have talked about this. We can't be the reserve currency anymore. Jared says dethrone King Dollar. He was a knucklehead, but he did write that report. We can't be. So how do you do it? If you look at the dollar index or any currency in the globe, they have to sell currencies to buy dollars, their currency to buy dollars, to buy oil, and to transact global business commodities. So over time, their currencies become worth less than ours. This is why manufacturing goes that way, to make 10x what you normally would. Instead of making it here, you make it there. So how do you get rid of this? You quietly default on the reserve status by letting gold go to the moon. All the gold that's been delivered here that no one has an answer for who the hell's doing it. Oh, it's just the banks. No, it's not the banks. They do cash settlement. They don't do that kind of delivery in number bars. But what if it was Bessent who said, you're going to do this, you're going to keep it quiet, we're not going to rattle the bushes, just leave it in your account, we'll take it as we need it. Or what about all the gold that has been accumulated by Tether that is now in bed with the U.S. government, and Trump's confidant is there managing USA Tether, and they buy all this gold. So in both cases, the USA is at an arm's length distance, the government, the Treasury Department. But they say to Tether, you guys will never be in trouble again. We're going to keep an eye on you, but you're going to buy gold with all of that accumulated interest that is not transferable to the holder of the stable coin that will devalue the dollar. And you'll quietly sell that to us, right, over time. But that's going to devalue the dollar better than anything because it is the only neutral asset by which anything can be measured. Not another currency measured against the dollar, measure that against any currency. And so by devaluing the dollar precipitously, not only can you reindustrialize, but you can actually sell the product to the world. You can give our children and grandchildren a future, a chance to actually be the engine of manufacturing again, not just IT. And you can have a reasonable shot at working down the debt by producing more than we consume in an environment where AI is here just in time to attack the labor market. I think that is what they want. I do believe that. Now, I might be wrong, But when you see all these deliveries and no one can explain it, and I'm the only one screaming about it, and people say, well, it's not leaving, so what? If you're the Exchange Stabilization Fund in the U.S. Treasury Department, do you give a crap if you leave it at COMEX in a Brinks vault and say, we'll take it slowly? We don't want to wake everyone up that it's actually us doing this. No one told me who took possession of 39 million ounces of silver, left COMEX in February. Who did it? Who has logistics capability to move 3 million pounds of silver in trucks worth $4 billion? Could it be Besant? Why did a lot of it stay here? Could it be the Treasury leaving it on COMEX to throw everyone off, using Tether to accumulate massive amounts to throw everyone off? But why? Because higher gold devalues the dollar better than anything else. Ask President Roosevelt about that. And as that happens, manufacturing becomes a reality. Soft defaulting on the reserve status becomes a necessity, and giving our children a future becomes a possibility.
Under recent legislative proposals like the Genius Act, global dollar movements will increasingly rely on digital stablecoins backed by short-term treasuries. This framework creates massive synthetic demand, pinning short-term interest rates to the floor while stimulating domestic business activity. The non-transferable interest generated by these short-term treasury holdings is quietly being funneled into physical gold reserves. By leveraging this mechanism, policymakers can execute a soft default on the dollar's reserve currency status without triggering immediate panic. Elevating gold's purchasing power serves as the ultimate neutral benchmark, naturally depreciating the currency against hard assets. This calculated devaluation levels the playing field for domestic production, offering a realistic path to work down national liabilities while preparing the labor force for an automated future. Now, let's get back to the interview.
We could point to the meeting in Russia where all but espionage by the BIS pulling out of Enbridge at the 12th hour, in my mind, to embarrass the entire platform, didn't dissuade the Chinese and the members who were involved in this to continue to forge forward. And I think the problem that we face in a lot of analytics these days, macro analytics, is pointing to a moment or a date. And this is what the Chinese and all of these countries seem to be very, very adept at, very good at. And that is to do things in a manner, creating these parallel systems in a manner that will slowly and ultimately rely less upon the US dollar. It is not to eliminate the US dollar. It is not to create a moment that not only shocks the world, but it doesn't do China or any of these countries any good. It would hurt their own balance sheet. And I think that the point is that as they continue to formulate trade agreements and payment systems and currency settlements, they're laying the tracks for a multipolar system. When we talk about Enbridge, it is operational. They have not brought out the unit because I think Trump would freak out. But what have they done instead? Well, they've set up, what is the unit? The unit is 60% BRICS plus currencies, 40% gold, redeemable by any of the central banks upon demand. It's a central bank to central bank platform. What has China done instead? Well, they've set up the payment rails. Enbridge is working, SIPS is working, and they've set up the vaulting system, and they're continuing to build more through the Belt Road. But the vault in Hong Kong that allows not only for settlement in yuan, but instant settlement, cash and carry, if you will, is really pretty much kind of the same thing, but it's just being framed as the internationalization of the yuan. It's the BRICS rails is what it is, and it's not to piss off Trump. Let's just call it what it is. But the infrastructure that is very quietly and very methodically being put into place does at some point become very difficult to reverse. And so, yes, we haven't heard, but you're seeing them continue to move forward, like BRICS Pay. They're moving forward with BRICS Pay, like the BRICS Grain Exchange. They're moving forward with the BRICS Grain Exchange. And like the BRICS Metals Exchange, they are now moving forward with the BRICS Metals Exchange. But, we've had this discussion, you and I, before when we were talking about the BIS and what they did at the last moment, which to me was right out of a James Bond movie, by pulling the plug on them at the 12th hour, embarrassing them. And I think it wouldn't be to anyone's benefit in these countries to be very, very candid about it. Like, for example, we just saw that China, in its latest move, is working directly with Africa's largest bank to settle trade directly in yuan. Now, we already know that China is Africa's largest trading partner. Is that the BRICS? Because South Africa is certainly a charter member of BRICS, right? They're the S in BRICS. And now if you can deal directly with the yuan, how hard would it be for them to say, okay, bang, now it's the BRICS currency. The rails are built. The settlement system is built. You want to sell us your stuff, we'll pay for it in yuan. And if you want gold for it, go for it. That's what they're doing. So how hard would it be just to switch train cars on the same train rails? It's not. Mm-hmm. So I think that is what is happening. And it's less a declaration of openness with the BRICS endeavors that proved to be fruitless and silly. Instead, what it is China taking the lead and saying this is all about us. But in my mind, it's all about building rails that can be quickly adapted to the BRICS system.
Meanwhile, Eastern economies are methodically constructing parallel financial payment rails that will irreversibly reshape global commerce. Rather than orchestrating an abrupt economic collapse, China and its BRICS partners are establishing robust operational infrastructure including mBridge, SIPs, and specialized gold vaulting networks in Hong Kong to execute seamless, non-dollar trade settlements. Expanding trade mechanisms like BRICS Pay, regional grain exchanges, and dedicated metals trading hubs enable participating nations to conduct instant, cash-and-carry transactions backed by physical commodities. A major upcoming milestone involves the unit, a proposed central bank settlement mechanism backed 60% by BRICS currencies and 40% by physical gold redeemable on demand. China's direct alliance with Africa's largest financial institution to settle commercial transactions directly in yuan showcases how seamlessly these new trade routes are operationalizing. As these modular platforms mature, global trade will progressively shift onto multipolar rails, gradually eroding Western settlement monopolies without destabilizing international balance sheets. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.